another set of videos where I will be talking about the admission chapter we have actually done in the previous videos. If you have seen carefully, the concept of sacrificing ratio, the concept of goodwill brought in by the partner and not brought in by the partner, and in this video I'll be talking about a full-fledged sum in which we will see what is there to be done. Now let us read the question over here. A and B are partners in a firm. The balance sheet of the firm as at 31st March 2020 stood as follows. On this date, C was admitted and the new profit sharing ratio became 4:3:3. So you can see very carefully that A and B are partners and no PSR is given. That means they are equal partners, and when the new partner is coming in, the profit sharing ratio is becoming 4:3:3. C brings in furniture of 20,000 and cash 80,000 along with his share of goodwill. Goodwill of the firm is valued at 2 years purchase of super profit. The average profit of the last 4 years is 75,000 and the normal rate of return is 15%. Prepare the balance sheet of the new firm after the admission. So you can see the balance sheet is given to you on the date of admission, and the new balance sheet will also be prepared on the same date because the admission took place on that particular date. And you can see over here the informations given in the asset side is goodwill, which is 40,000, land and building 2 lakh, non-current assets which is 1,65,000, that is other non-current assets excluding goodwill and land and building. Then we have current assets of 75,000 and there is other current asset which is cash at bank, which is 20,000. Now if you go to the liability side of the balance sheet, we have capital of A and B as 2 lakh and 1,50,000 respectively. We have a general reserve of 50,000 and we have workman's compensation fund of 40,000 and we have creditors of 60,000. So the balance sheet tallies at 5 lakh. The question has asked us to prepare the new balance sheet after the admission. We'll be doing that. But over here there are two things which has to be taken into consideration. Number one, the new profit sharing ratio is 4:3:3 and we have to calculate a sacrificing ratio because we know the old profit sharing ratio is 1:1, and we also have to calculate the goodwill of the firm, which will help us to calculate the goodwill of the new partner. After reading the question, we have come to know that initially there were two partners, A and B, and they were equal partners with a PSR of 1:1. Now they have taken a new partner, A, B and C, and the profit sharing ratio has become 4:3:3. We are informed that the new partner C has brought in 20,000 worth of furniture and has also brought in 80,000 as capital. So the total capital over here, if you see very carefully, is 20,000 worth of furniture in assets and 20,000 in cash. Moreover, it is also being said the new partner has also brought his share of goodwill, and the goodwill is valued on the basis of super profit. Okay, so first we'll calculate the concept of sacrificing ratio, then we'll move on to the calculation of goodwill, and then as the question has asked us, we will prepare the balance sheet of the new firm. But to prepare the balance sheet of the new firm, we need to prepare the capital account of the partners, because without preparing the capital account of the partners, will not be in a position to find out what will be the capital balances of all the three partners. So let's get started with the first step, calculation of the sacrificing ratios. Now we know that there are partners A and B with 1:1, ABC, the ratio of 4:3:3, and we are needing to calculate a sacrificing ratio. Formula is old ratio minus new ratio. So therefore for A, the calculation will be half minus 4/10. That will give us 5 minus 4, that is 1/10. And that for B, the calculation will be half minus 3/10, that will be 5 minus 3/10, that is 2/10. Therefore, sacrificing ratio is 1:2. So the first part of the question we have calculated sacrificing ratio. The next part of the calculation is to calculate the goodwill of the firm. So we'll calculate the goodwill of the firm. If you read the question very carefully, the goodwill is calculated at 2 years purchase of super profit. Now this term super profit, what does it mean? Super profit is average profit minus normal profit. You can see very carefully, the question has given you a normal rate of return as 15% and the average profit is actually given to you as 75,000. If you read the question, you will get these information. Now, whenever you are calculating the normal profit, the formula which will be used to calculate normal profit is capital employed into normal rate of return. Here, if you see, the capital of A is 2 lakh and capital of B is 1,50,000 and there is a general reserve which is 15,000. All these three will be taken into consideration to calculate the capital employed. So the capital employed is 4 lakh. And if you calculate 15% of 4 lakh, which is the normal rate of return given in the question, we will get the amount as 60,000. So the normal profit is 60,000. If the normal profit is 60,000, what will be the super profit? Therefore, super profit will be 75,000 minus 60,000, which is 15,000, and 15,000 multiplied by 2 is 30,000. So the goodwill of the firm is 30,000. Now the goodwill of the firm is 30,000 and new partner is bringing in his share of goodwill that has actually been told to us. So what will be the new partner's share of goodwill? So if we see very carefully, 30,000 into 3 by 10, the new partner's share of goodwill will be 9,000. And now 9,000 will be given to the sacrificing partners in the ratio of 1:2. Therefore, first partner will get 3,000 and second partner will get 6,000. So these are the calculations we should be very clear about. Number one, we calculated sacrificing ratio. Number two, we calculated the goodwill of the firm, which had come to 30,000, and then we calculated the goodwill of the new partner, which had come to 9,000, and we have distributed the goodwill in the sacrificing ratio, 3,000 to the first partner A and 6,000 to the second partner B. After going through these calculations, we also know that half of the goodwill is withdrawn by the partners. That is, A and B has withdrawn half the goodwill which has been given to them. And you can see very carefully over here, half the amount of 3,000 will be 1,500 and half the amount of 6,000 will be 3,000 that will be withdrawn. So the question has asked us to prepare the balance sheet of the firm, but I have already told you we will not be in a position to prepare the balance sheet until and unless we prepare the capital account. So now let us prepare the capital account of the firm and let us see what is the balance of the three partners. So we'll start with the preparation of the capital account. There are three partners, A, B and C. So we'll start with balance. Brought down, we have three partners A, B and C, and if you see the capital of the first partner A is 2 lakh, the second partner's capital is 1,50,000 and this is the new partner. The information given to us is a general reserve. So by general reserve we can see 50,000, and since nothing has been said about the profit sharing ratio, it will be treated as equal and we will distribute 15,000 into 25,000 to the first partner and 25,000 to the second partner. We also have been given a workman's compensation reserve or workman's compensation fund as the question gives you. Here the value is given as 40,000 and 40,000 will be given to the old partners in their ratio. Therefore, by workman's compensation fund, and we'll have 20,000 to A and 20,000 to B. Okay. Now we are also informed that there was a premium for goodwill of 9,000 which has been brought in by the new partner. Okay. So by premium for goodwill, and we can see over here the value will be given 3,000 first partner and 6,000 to the second partner because it is 2:1 as the sacrificing ratio. We have also been informed that half of the goodwill has been withdrawn. So if half of the goodwill has been withdrawn, we go to the debit side, write to bank and write 1,500 in A. There are three partners as you know, and over here 3,000 for B. After that, by furniture 20,000, this is being brought by C, and by bank or by cash over here 80,000 has been brought in by C. So this is the capital which is being brought in by the new partner, 20,000 in the furniture and 80,000 in the form of cash. Okay. So after doing all these entries, we also see that there is a goodwill which is there in the balance sheet in the asset side, and the value of the goodwill is 40,000, which will be written among these partners. So to goodwill 20,000 the first partner and 20,000 to the next partner. So this is what we have actually done, and after that now we'll find out the balance of all the three partners, and after finding the balance only can we prepare the balance sheet of the new firm. So let us find the balance. So to balance, carried down, let us add this. You can see very carefully the value comes to 2,48,000. Here the total is coming to 1,50,000 plus 20, 1,70,000, 1,70,000 plus 25, that is 1,95,000. So it is coming to 2,01,000 over here, and the total over here is 1 lakh. So 2,48,000, 2,01,000 and 1 lakh. Now let us subtract and find out the balances. So 2,48,000 minus 20,000, that gives us 2,28,000. 2,28,000 minus 1,500 is 2,26,500. So the balance of the first partner is 2,26,500. The balance of the second partner, you can see over here we have 2,01,000 minus 20,000 gives us 1,81,000. 1,81,000 minus 3,000 gives us 1,78,000. So over here we are having 1,78,000, and the capital balance of the third partner is 1 lakh. So after preparing the capital account, though the question did not ask to prepare the capital account, they have just asked us to prepare the balance sheet of a new firm. But I have told you that until unless we prepare the capital account of the partners, we will not be in a position to understand what is the capital balance of the three partners. So we can see over here the capital balance is 2,26,500, 1,78,000 and 1 lakh. This is not done. Please bring forward the balance by balance brought down. See over here 2,26,500, then we have 1,78,000 and finally we have 1 lakh. After doing all this, finally we will now prepare the balance sheet of the new firm, taking into consideration the information which are given to us in the balance sheet. After doing the workings, now let us move on to what the question has asked us, that is the preparation of the balance sheet. So, balance sheet as at 31st March 2020. Now, we have the capital balances. So let us start from the liability side, then we'll go to the asset side with the information which we have. Capital account, you can see A, B and C and their balances. 2,26,500, 1,78,000 and 1 lakh. Now let us add these three figures and we are getting over here 500. So over here next we see very carefully. We are having 14. Next we are having 0. 5 lakh 4,500. We have a value of creditors as 60,000, and the assets which we have. The first asset which we have is land and building, that is valued at 2 lakh. We have non-current assets valued at 1,65,000, and if you see very carefully, the new partner has brought in furniture worth 20,000. So there is a furniture of 20,000. We are also given information about current assets of 75,000, excluding a cash bank balance of 20,000. So we have current assets. The value is 75,000. And now we have a figure of bank which is given to us as 20,000. With this, we need to add the cash brought in by the new partner for the form of capital, which is 80,000. Also, the new partner had brought in goodwill of 9,000, and out of which 4,500 was withdrawn by the partners. Please see very carefully, 4,500 has been withdrawn by the old partner. The goodwill which was brought in by the new partner was 9,000, which we are actually calculated over there. So you can see very carefully the value which we are having of bank is 1,04,500. Okay, so the value which we are having over here is 1,04,500. Now we know that at a given date, the balance sheet, asset and liability side should tally, and let us see what is the total of the liability side, then we'll go to the total of the asset side. So after adding the liability side, we have got a figure of 5,64,500. Let's see the value of at the asset side. You can see very carefully 2 lakh plus 1,65,000, that gives us 3,65,000. 3,65,000 plus 20,000 gives us 3,85,000. 3,85,000 plus 75,000 gives us 4,60,000, and 4,60,000 plus 1,04,500 gives us 5,64,500. So this concludes the sum which was given to us about the preparation of the balance sheet. If you see very carefully in this question, there was no revaluations of any assets and liabilities, and the question has directly asked us to prepare the balance sheet of the new firm, which we have done. There was no journals asked, there was nothing else asked, but to prepare the balance sheet of the new firm, we have told you that we have to prepare the capital accounts of the partners, which we have done, and we have found out the balance which we have taken here, and ultimately we have found out the balance sheet total at 5,64,500. I hope this calculation was very clear to you. Keep watching my channel. Don't miss any of my lectures, and if you have not yet subscribed my channel, subscribe it, and I'll be coming up with new sums where we will talk about the preparation of the entire sum. We may have the preparation of revaluation account coming very soon.